Hi, good evening, everyone. Thank you for joining the call. We'll just give it one more minute just for people who are still dialing in to join fully before we start off. So please bear with us. Okay, so let's start. Good evening, everyone. On behalf of Axis Bank, I welcome you to the 17th edition of Treasury Market Talks. As you know, Axis Bank serves a very wide spectrum of customers through its innovative financial solutions and products. We leverage the power of technology to provide uninterrupted, best-in-class service. But we also aim to equip our clients with high-quality inputs on emerging issues and have emerged as a respected thought leader. I am Neelkanth Mishra. I work as the chief economist for the bank and also the head of global research for Axis Capital, which is the investment banking subsidiary of Axis Bank. As part of the thought leadership initiatives, Axis Bank has been organizing Treasury Market Talks. We call them TMT, which is a talk series on diverse topics such as central banking, fiscal policy, geopolitics, macroeconomics, financial markets. This is the 17th TMT. We have hosted many eminent speakers in the past, and some of you have joined us for that. We are absolutely privileged today to have with us Professor Michael Pettis of Peking University. Like me, I'm sure many of you are followers of his research. He's been a prolific writer and one of the most astute commentators on China. So he's here to talk about China's economic model and its impact on India. Some of the housekeeping points are on display. Basically, they talk about the restrictions on unauthorized dissemination of contents, and also that this conference is being recorded. We will have about a 35 to 40 minutes of fireside chat. So I'll be asking questions, and this will be followed by questions from the audience. You would have seen a question box into which you can type the questions. They will be then relayed to me, and I will then ask them on your behalf. So yeah, Michael, absolutely a pleasure to be talking to you. It's almost a fanboy moment for me to be asking all the questions I wanted to ask in person. So let me start off with the question which is on top of mind for everyone, right? So it's now consensus that China's lopsided growth model must change and that domestic consumption has to take over. Now, can you elaborate on why it makes sense on paper but has not been adopted yet? And a quick follow-on to that, because one of the concerns, I believe, is what it does to inflation. And now that China is in deflation, does it make it more likely that some consumption stimulus could be underway?
Thanks very much for having me here, Neelkanth. It's a pleasure to be with you. That's sort of the key question in China, and one of the things that I like people to think about when they think about China is just how extraordinary the imbalances are. These are imbalances that we've never before seen in history. So the one that most people talk about is the consumption share of GDP. It's the lowest we've ever seen. And the reason is very straightforward. It's not because the Chinese like particularly to save. In recent months, they've been saving because rising uncertainty normally gets people to save more. But the real problem in China is the household share of GDP is probably the lowest in the world, certainly the lowest for any major economy. And of course, your spending depends on your income. So if your income is a very low share of what you produce, then by definition, you will consume a very low share of what you produce. Um, the flip side of that very low consumption share is extraordinarily high investment share. And this is the number that I think people must really understand. And unfortunately, we don't talk about it enough. Um, Investment is roughly about 25% of GDP in most countries. That ranges in advanced economies, it tends to be lower, capital rich economies. In very poor countries that are not growing, it also tends to be lower. And lower typically means 18 to 20% in that region. And then you have you have high investment, rapidly growing countries. They tend to be developing countries that are growing quite quickly. And they typically have investment of 30 to 33% of GDP. So that tends to be the normal range. Chinese investment is 44% of GDP. And the only time that's ever been beaten in history is by China itself. A few years ago, it was investing as much as 47% of GDP. Now, is this a good thing or a bad thing? We typically think of investment as a good thing. And certainly in countries like India, you want to invest more. There is a need to increase investment. And in the case of China, when China started this growth model more than 30 years ago, it had gone through 50 years of anti-Japanese war, civil war, and Maoism. So it was hugely underinvested. I mean, it was terribly underinvested. So this growth model was a very successful growth model. It increased investment at a very high rate. And that investment was funded by domestic savings, so it was quite stable. And so China grew very quickly. But the problem with a successful growth model, and this is something that I think Albert Hirschman used to speak a lot about in the 1960s and 1970s, and it's something that I think as India starts to grow very, very quickly, India will also have to think about. The problem with a successful growth model is that by definition, it makes itself obsolete, right? The successful growth model addresses your particular problems and it resolves them. And once it resolves them, it's no longer a useful growth model. And this is what happened in China. As long as it was seriously underinvested, a high savings, high investment model was just what the doctor ordered. But as it closed the gap between the investment it had and the investment it could productively absorb, it needed a different growth model, no longer a high investment model. But historically, it's very hard to shift away from a successful growth model. And China hasn't been able to do that. I would argue that this model became obsolete probably in the middle of the 2000s, 2005, 2006. But since then, the investment share of GDP has remained still the highest in the history of the world. And as a result, more and more of this investment became non-productive. And what happens when you invest non-productively, if you fund it with debt, of course, debt starts to grow faster than GDP. And China has had, another one of the superlatives of China, is China has had the most rapid growth in debt. Again, perhaps in history, I can't find another country in which debt grew so rapidly, the debt to GDP ratio. Now, that can go on for a while, but ultimately, you can't get rich by building stuff you don't need. And China was effectively trying to get rich that way. And as a result, we saw the explosive growth in debt. This became a problem, as I said, 10, 15 years ago, but it wasn't really recognized a problem, except for a few of us. Most people didn't see it as a serious problem until 5 or 6 years ago, when they kept talking about reining in the growth of debt, and there was nothing they could do to stop it from growing. So eventually, the realization came about that in order to stop the growth in debt, you've got to stop all of this non-productive investment in the property sector and in infrastructure. And that's going to be very painful, but they underestimated how painful it would be. So 2 years ago, we had the first step. And the first step was they clamped down sustainably on the real estate sector. It's not the first time they tried to clamp down on it. They've tried many times before, but they always backed away. In 2021, they clamped down and they didn't back away with all of the consequences I don't need to tell you about. And then this year it was the recognition that local government debt had gotten out of hand. So a number of provinces started effectively defaulting, and that's been spreading. So they're now trying to restrain that. So the growth has slowed significantly because they're trying to bring down those high investment levels. I'll say one last thing. I'm aware it's a very long answer, Neelkanth, but I wanted to set the framework.
Mm-hmm. Yes, absolutely.
And the thing that I'll say is, basic economics, GDP is equal to consumption plus investment. For an open economy, consumption plus investment plus net exports. But if you're the size of China, or indeed the size of India, you cannot depend on net exports. You're too big. The world can't absorb it. If you're Singapore, you can do that. So basically for China, GDP is investment plus consumption. So if you bring investment down, the growth rate of investment down, then either you must bring up the growth rate of consumption or GDP growth will drop, right? That's just the equation. And they don't want GDP growth to drop, which is why there's this constant talk about bringing up the growth rate of consumption. And now we agree you got to bring up the growth rate of consumption because you have to increase the household share of GDP. But where the conversation hasn't yet gone is the obverse of that. So if I increase your share, I have to reduce somebody else's share. So we're talking about increasing your share, but no one is talking about whose share is going to get reduced. In other words, where the transfers are going to come from. And I would submit to you that that's the hard part. Giving money is easy. Taking money is the hard part. And so far, Beijing really isn't talking about where those transfers are going to come from. So we've got a couple of more years of this really difficult process of trying to figure out what happens. And during this period, growth rates are just going to continue to slow.
Well, that's quite fascinating and very comprehensive. I think it sets the stage for my next question, which is that this construction of real estate, and I read this ridiculous number that the average constructed floor space, actually it was in a Ken Rogoff paper, that it is now 550 square feet per person in China, and versus 700 square feet per person in the US. And I struggle to believe that it's 100 square feet in India. But when you build these houses and for speculation, not for living, and you have these bridges to nowhere, it adds to GDP while they are being built. But then these assets are not worth it, so someone has to bear the losses. Yes. This wealth has to be written down, and so. How does that happen? Because that's the trickier part, right? I mean, I think growing into higher debt is one, but at some point, I think some of these assets also. So is that imminent? Will that be forced upon the governments? Is that something that the government can control?
In theory, yes. They often don't, but in theory, yes. And you'll remember Brazil, which followed this growth model, had enormous amounts of bad investment in the 1970s, and basically the 1980s was about writing it down. The Soviet Union followed this model. The United States in the 1920s and the 1930s was about writing it down. Writing it down is quite painful. But as you point out, there's really no secret to bad debt. The way you resolve bad debt is somebody has to take the loss. Yeah. If you default, it's the creditor who takes the loss. If you inflate it away, it's households who take the loss. Right. If you raise taxes, it's the taxpayer who takes the loss. But somebody has to take the loss. And the way I think about it, trying to think about it as systemically as possible, there are a few groups in theory that could take the loss. One is households. And typically households end up taking banking losses. They did in the last banking crisis in China in the 1990s. They did in the US, etc. The problem is you can't have households take the loss again because you've got to raise the household share of GDP. And if they take the loss, you'll reduce it. You're going in the wrong direction. So who's left? Well, in theory, foreigners, but foreigners are too small to matter. So even if you could figure out how to take it from them, it's not going to work. There's business, but you don't really want to assign the losses to business because then you undermine growth in the economy. As you know, the private sector is the one good part of the Chinese economy, and you could undermine it, but that would be very foolish in the long run. And so there's only one other sector left, and that's government. And you can divide government into the central government and into local governments. And if you're Xi Jinping and you want to centralize power, it seems to me pretty clear what the strategy must be. And that is you must force the adjustment costs onto local governments. And we're starting to see that. We're seeing, there's plenty of evidence that that's the direction they want to go in. But I think one of the things people don't understand about China, and again, in India, I think you're very familiar with this, and that is the central government doesn't have total power. Local governments, local provincial governments are very powerful. So you've got to have this pretty contentious conflict over the next couple of years in which local elites are going to want to protect the power of local governments because that underpins their own wealth and power. And Beijing is going to want to force the local governments to pay the adjustment costs. I can't tell you how that fight will resolve itself, but it seems to me that that's the key conflict of the next couple of years.
And the way you are framing it, I think it's a systemic issue, and the fact that at least for those of us watching China from outside, it seems that there has been a lot of consolidation of power by the current central leadership. But from what you're saying is that while that may have happened, it is still a challenge. And to be honest, if I think about some Indian state. The state electricity board is incurring losses. You cannot let one SEB go scot-free because then the others are going to start behaving like that as well. And so there is an element of moral hazard. There is an element of, what cost did they have to bear and all of that. But that brings me to a much more important question, which is when I plot the history since 78, right? If you remember, you would know that in 89 they had February 89 they had 28% year-on-year inflation. In the late 1990s they had to take away what they called the iron rice bowl. They had to fire a lot of people from state-owned enterprises. 2003 they had to massively recapitalize their SOE banks. 2009 they launched a massive stimulus. So this is not the first time that the government has faced a problem, right? And where it seems like there's no way out, no easy way out. What are the chances of them again pulling a rabbit out of the hat and then taking China from the middle income level to the higher upper income level?
Yeah, there have been many crises, we can call them, in the past, and every time Beijing has sailed through. And that's created this perception that one thing they're very good at is crisis management. Every time they've had a problem, they've resolved it, and they've managed to keep growth rates really high. But you have to be a little bit careful about that perception because you'll notice that the resolution to every problem has been basically the same: step on the investment accelerator. So when they rationalized the SOEs in the late 1990s and fired so many workers, you had explosive growth in the real estate sector and the property sector. When they cleaned up the banks, you had a lot of growth in infrastructure. In the 2008-2009 crisis, when China's current account surplus collapsed from 10% to 3%, you saw a massive increase in railway building and other forms of infrastructure investment. So the solution to every problem has been the same solution: step on the investment accelerator. The problem is that once your problem is too much investment, then stepping on the investment accelerator cannot be a solution. And that's why this has been a much more difficult problem than any that they've had in the past. Because in the past, they always had a very simple solution, and that was to increase investment. Now their problem is they must reduce investment and bear the economic costs of reducing investment. And the only way to balance that is with a surge in consumption. But how do you get a surge in consumption? You need massive transfers of income, again, from local governments to the household sector, and then you'll get that surge in consumption. So you're still stuck with the basic problem. This very politically difficult problem of massive income transfers from local governments to the household sector. Can
Right.
I add one thing, Neelkanth, that I think a warning to your clients, and that is the China story is over, right? The China story was the economy was growing so rapidly at 10% that whether you were in the fast growing part or the slow growing part, it was still growing very rapidly. So consumption was a slow growing part, but it was still growing at 7%, which most countries would kill for. That story is over, and China now becomes a more normal type of story, like Europe, like the US, like India. And that is, there's no longer a country story. There are lots of different stories. There are parts of the economy that will perform well, parts that will perform badly. And I think it's really important to understand this adjustment process, this rebalancing process, because parts of the economy will do reasonably well. Other parts will do absolutely terribly. But the reason I bring this up now is that you should also think regionally, because there are 6 or 7 provinces in China, Guangdong, Zhejiang, Jiangsu, Shanghai, Beijing, Fujian, and maybe Tianjin, that are pretty wealthy, that have diversified economies, that have growing working populations because of immigration. And with the exception of Tianjin, they have debt problems, but they're manageable. And then you have the rest of China, which is about 2/3 of the population, which are really in serious trouble. They have rapidly declining working populations. They have unmanageable debt problems. They have very low incomes and usually not terribly diversified economies. So I would say one of the things you really have to watch in China is, which China you're in. Parts of it will be fine. Parts of it will do terribly. And so then there's a political issue of how do you sort of moderate the good parts and the bad parts.
No, that's very nuanced, and I will come back to that point. But before that, now that we are at least starting to explore what the implications are for the rest of the world, so a sharply slowing China, and I don't know if the 5% or so now, if the government is at 5.5, people are at 5, and they say, oh, we are well below. But the way some of the demand indicators are showing up, it doesn't look like they're even growing at 4.5. But the point is, how does this affect the rest of the world? So how much of this is China's problem, and how much of it is the world's problem?
One of the mistakes I think many people make is they look at the Chinese share of global GDP, which is very high, depending on what period you look. It could be 30 to 40% of all growth in the past has been Chinese. And they extrapolate from that. They say if Chinese growth slows significantly, that's terrible for the world because China is the growth engine of the world. And that's a big mistake. China is not the growth engine of the world. China is just the biggest arithmetical component of global GDP growth. The growth engine of the world is demand, and China is a net absorber of demand. It has the biggest trade surplus in the history of the world. I mean, it's really astonishing. And so it's taking demand from the rest of the world. And what matters to the world is not what happens in China. What matters to the world is China's balance of payments. So we have to think about, how does the balance of payments adjust? If China adjusts in a very slow but stable way, which is what I expect, which is how Japan adjusted after 1990, we should see investment come down, and we should see savings come down even faster, in which case that's just another way of saying China's current account surplus will contract, and it will be mildly positive for the world, right? A lot of people will say China growing at 2% is a disaster for the world. But remember, when Japan was growing at 0.5%, that seemed like it should have been a disaster, and it wasn't. The world was fine in the 1990s. And that's because the Japanese current account surplus contracted. If China adjusts in a stable way, the same thing will happen. It'll be a very long adjustment with a contraction in the current account surplus, so mildly positive for the world. But mildly positive for the world is an average. The world will be very seriously affected by a Chinese slowdown because you have GDP growth in China, which is quite high, investment growth, which is much higher, and consumption growth, which is much lower. Now, a rebalancing China will involve much lower GDP growth. I think 2 to 3% is the upper limit of a sustainable growth rate. But that doesn't mean everything comes down. Ideally, the growth rate of consumption shouldn't come down a lot, which is a way of saying that the growth rate of investment will collapse. It'll drop a great deal. And even investment, we have to separate it because private sector investment will continue to grow in line roughly with GDP. It's investment in property and infrastructure that will collapse. China is the biggest commodity, the biggest absorber in history of industrial commodities, iron ore, copper, et cetera, et cetera. Why? Because of its incredibly high investment rate. As that comes down, I would say if you are an exporter of iron ore or of copper, you probably have a lot of trouble. If you're an importer, you're fine. In fact, you benefit from a reduction in prices. If you are an agricultural exporter, you'll probably be fine because as growth rates collapse, the growth rate of household income will drop only a little bit. So the Chinese will continue to move up the calorie scale and consume more food. So I think that's really the way to think about it. The overall impact of a slowing China on the world is probably positive. That's not the case if we have a collapse in China. That would be very negative for the world, but I think that's quite unlikely. But that's positive for the world will be very unevenly distributed. Some countries will benefit a lot, other countries will be hurt pretty badly.
Well, that's very nuanced, and thank you for that. But I have a follow-up on that, which is that if, so as you said, if investment activity starts to slow down, then even income growth for workers, I mean, so basically the Chinese consumer, and then the sentiment starts to change again. And remember that this is a very rapidly aging society. So, and the pension assets as a percentage of GDP are even lower than India. I mean, I couldn't believe it when I first saw it. I thought India was not saving enough, but in China it's even lower. And we had done this survey last year where we found that most people save for medical emergencies, for old age, and so on and so forth. And the classic 4-to-1 problem, right? So there's an aging population, and there is one person to take care of 2 parents and 4 grandparents. So right. In this environment, if growth rates are slowing down and infrastructure construction and real estate construction start to slow down, how can consumption even hold up?
The answer, and it's the only answer, is transfers. Remember that for 30 years, while China was growing at roughly 10%, household income was growing much more slowly at 7%. So somebody's income, which meant businesses and local governments, their income was growing at 13, 14%. Local governments in China own a lot of assets. Some of them are really absurd. They own restaurants, they own convention centers, they own hotels, but they own a huge amount of assets. Now, this is politically important because by controlling all of these assets, they really control the distribution of wealth and power within the local regions. But at the end of the day, they're going to have to be forced to liquidate those assets and transfer the resources directly or indirectly to the household sector. You know, for example, they could increase the pension system. Very complicated in China, but it's a terrible pension system. They could improve it without too much trouble. Or instead of selling land to the highest bidder, to build luxury apartments that are going to remain empty for speculative purposes. They could build very cheap housing and give it to the poor or rent it very cheaply to the poor. There are a lot of things they can do that basically transfer income to the household sector. So after many, many years in which household income grew more slowly than GDP, rebalancing means that household income has to grow more quickly through these transfers. And as we discussed many times, these transfers are ultimately very political and very politically contentious, and that's what Beijing has to resolve. One way or another, they will. The question is how.
Yeah, and at what point? So, in fact, that brings me to the next question. I mean, of course, I have several more, but I realize that I'm running out of my own time and I have to move to audience questions. But the point is that when we think about this shift towards as you said, the hard political decisions that need to be taken. The hard political decisions require, I mean, just like, the severity of the disease decides on the intensity of the medication. So at what point are they forced into making a decision? So one of the things about policy making is that you don't want to take tough decisions if you don't have to. But at what point will there be no option, and it will be only a choice between two politically bad options? So when does that happen, and what are the indicators that we can see towards that?
Well, if you don't have infinite debt capacity, and I think we would all agree you don't have infinite debt capacity, then this game can continue until you're no longer able to increase debt sustainably. When is that? We don't know. There are so many moving parts. But what we do know is that you don't want to find out, because when you found out what is your debt limit, usually you adjust in the form of a crisis. So to its credit, China doesn't want to find out, and you could argue that they came down hard on the real estate sector 2 years ago, much too late. They should have done it 10 years ago, but still they did it because they recognize that you can't continue building infinite amounts of real estate. And this year they're coming down on local government borrowing for exactly the same reason. So it seems that they have made a political decision that they're not going to see how far they can go before the whole thing breaks down. Having said that, it's a very difficult decision. And the debate seems to be that most of the economically sophisticated policymakers and policy advisors, people around the central bank, around the Ministry of Finance, academic advisors, not all of them, but most of them now agree with this framework. And they agree that you've got to raise the consumption share, which means you have to raise the income share, which means there have to be transfers from the government. But I would say that local party secretaries, local provincial governors, people in the military, people in the foreign affairs, they don't understand that. For their point of view, China had the best growth model in history, and to stop this growth model is insane. It should continue. So I think that's the debate that's going on within China. There are a number of people who are saying this cannot continue, we must stop. And there are other people who are saying, no, it was great while we were doing it. Why should we stop? And that's what I mean. The next couple of years, I think, are going to be quite difficult because you have to really resolve that. There's no way this growth model can continue much longer, but you have to convince quite a lot of people. And, I say this with some trepidation. You're not supposed to say anything disparaging about the leadership, but there are very strong rumors within Beijing that she's a bit like our President Nixon. He's very good on security issues and on foreign affairs issues. He finds the economy totally boring. And the purpose of the economy is not to interfere in the real purpose of governance, which is, geopolitical, etc. I don't know if that's a good thing or a bad thing. It's a bad thing because it means he doesn't understand economics. It's a good thing because it means he will probably leave the economy to people who do. But I think that's one of the conflicts that has to be resolved.
Yeah, and some of the changes that have happened in this in the last sort of change of government have not given comfort to people. But this also brings me to the point. That a lot of what you've said today, and I noticed that every time you've said that over the next couple of years, this is this resonates with the concern many have had that we are going to see a Japan-like situation for a sustained period. That you have a heavy period of investment, excessive savings, and then there is a reluctance to take the hard decisions to move to the next model. So is that something that you anticipate? Is there some merit? What are the major differences between China being the next Japan?
Well, there are two big differences. One, of course, is Japan was much richer. It's not clear how that matters, but it's an important difference. But the other big difference is that we saw all of these imbalances in Japan, but they were much deeper in China. China's had much deeper imbalances than Japan has, which suggests a more difficult adjustment. Now, historically, countries that have had this problem have only adjusted in two ways. One way I call the American way, which is how the US adjusted in the 1930s. You saw a huge, rapid contraction in GDP of around 35%, brutal. And you saw a contraction of roughly half of that in household income. So also very brutal, but notice it rebalanced. The household income share of GDP went up. In Japan, you had 30 years of GDP growing at roughly 0.5% and household income growing at roughly 1 to 1.5%. So again, it rebalanced. And those seem to be the only two historical models that we have. So which is most likely to happen to China? I think China will do everything it can to prevent an American-style adjustment, because that'll probably be politically disruptive. In the long term, the Japanese-style adjustment is worse. The economic impact is much worse, but you don't have, the brutal social and political impact. So I think that's what China will try to do, and I think it will succeed, because ultimately, if you control the financial system, and if you're able to restructure liabilities at will, which the regulators can do, you'll never have a bank run, right? You can resolve bank runs very, very quickly. You won't have a crisis. So I think that's probably what's going to happen in China. Technically, there's a third solution. No country has ever done it. But in theory, if Beijing could get local governments to transfer roughly 1.5% of GDP every year from local governments to the household sector, then in principle, you could have consumption growth, go up to maybe 6 or 7%. And that would pull GDP growth at roughly 4%. So you could keep high levels of GDP growth by causing a surge in consumption. As I said, it's never happened before in history. That doesn't mean it can't happen, but I think it's quite difficult to do.
No, thank you. And one quick last question from me before I move to the audience questions. So a lot of what we've discussed is over the medium and long term. So over the near term, and if I remember well from your recent tweets and some of your posts, it seems that you think that some of the recent steps are going to be supportive of overall economic activity, that the changes maybe attempted 3-6 months back were not strong enough, but now they're increasing the dosage, and perhaps we will see some improvement. So what do we see as the economic momentum? I mean, the economic momentum in the recent weeks has been, and the news has been pretty disastrous. Do we see a revival from here, a very short term, but at least a meaningful revival?
I think we will, just because things are bad enough that they don't want to, there's a real question whether they'll hit the 5% growth target. I think if they come under, that will be perceived as a real failure on their part. So I think they're going to want to take steps to make sure they hit or exceed the growth target by a little bit. And unless we see a major recovery in consumption, and so far there's no reason to assume that's going to happen, the private sector isn't investing because they invest for consumption and exports. Exports are weaker, consumption is stagnant, so they're not going to invest. So the only source of growth has to be either the property sector, which I don't think they can revive, or more infrastructure spending. So what we need to do is watch local government borrowing or Ministry of Transportation borrowing to see if we see a big increase in infrastructure spending. That should show up in the price of iron ore and various industrial commodities, and I expect we'll see it. But I would warn that this is going to be very temporary. They simply cannot sustain that. And the good news is they've reached the point, a little late, but they've reached the point where they know they cannot sustain that.
Thank you. So no, I still have several more questions, but we are 40 minutes past the hour, so I think it's time to let the audience ask some questions as well. So let me start with a question from Nitin Parikh of Hindalco. So he asked that China has built up strategic interests in a number of industries and commodities, and so what is the long-term vision underlying this? I mean, what aspects of the global economy would they be able to dominate? So I guess this is a question more from the supply side than the demand side. The demand side, we all know, I mean, they're 55% of steel, 50% of aluminium. But from the supply side, what do you think strategically they would like to continue to dominate?
There's a heavy focus on the high-tech side of the economy and on the green side of the economy. Looking at the historical precedents, I think we have to be a little bit skeptical because this is always the answer, right? Every time a country runs into the problem that China currently runs in, whether it was Japan in the 1990s, the Soviet Union in the 1970s, Brazil in the 1970s, the solution is always technology. The problem is two or threefold. One is that the amount of investment that has to be reduced is enormous, and the tech sector is quite small. So it's very difficult to funnel all of that investment into the tech sector. But what it does mean is that the tech sector will be heavily supported. Now, is it sustainable? Can it be commercialized? That's the second problem, and that is that the tech sector already receives so much capital that I don't think the constraint is capital, in which case adding more capital is not necessarily going to be sustainable. That does mean they're going to be extremely competitive on the tech side, but it won't be sustainable. So what I would say is that over the next few years, China is going to compete very heavily on the tech side. And one of the responses of countries like the US, Europe, presumably India, is that there's going to be more protection of the domestic technology sector, because you simply will not be able to compete with the amount of subsidies that Chinese manufacturers have received and will continue to receive. So it'll be interesting to see how that plays out, because it depends on what the rest of the world does too. But that side, I think, will be flooded with capital, will be very competitive, and we should see quite a few advances there.
Thank you. The next question is from Mr. Ganju of Larsen & Toubro. So he asks about the options in boosting domestic consumption, right? And just to add to his point, so we've discussed some of what he asked, but I think just to add to his question, see, we've discussed consumers as one block, right? But there is also incredible levels of wealth and income inequality in China. So what are the chances of the government being able to tax more and allow more balancing to happen? As we know, there are limits to a threshold of like consumption by the rich. I mean, mostly higher income will go into savings, but if you give more income to the poor, they will end up consuming, and that propensity is higher. So why is China's tax to GDP so low?
Because tax revenues in the past, they followed the Hong Kong model, where you basically use land sales in lieu of taxes, and that's really good for businesses. It's really good for the wealthy, etc. But we've reached the limit of that model. So there's a lot of talk about taxes. I have two problems with it. The first is, do we need to redistribute income from rich Chinese to poor Chinese? Yes. And from rich Americans to poor Americans, and from rich Indians to poor Indians, and on and on and on. It's quite hard to do, right? It's politically very tough to do, but we need to do it. But the bigger problem is that I see income inequality as the American problem, or maybe even the Indian problem. And the reason I say that is because household income is about 80% of GDP in the US, and business is about 20%, right? So if you think there's a problem with the distribution of income, it's probably in the distribution of household income. But in China, household income is only 60% of GDP. Business is roughly 20, government is roughly 20. I say roughly because we don't know where to draw the line. But the real problem in China is the very high government share. So if you redistribute income from rich to poor, you'll help at the margin. I'm not sure that's the solution. That allows you a little bit of time, but the real solution continues to be you've got to take away this huge share retained by local governments and redistribute it to the household sector.
Thanks for that. And there's a question from Mr. Rahul Rana of NTPC, which I guess is about what is the threshold of pain to break through the quote unquote strategic composure, and what would things look like if this is crossed? Like, for example, we have seen already that they are in deflation, and that's terrible if you have such high levels of debt. And we have seen some of the financing vehicles, some of the shadow banking sector, large companies now defaulting, and so from the outside, and now of course the export engine, it seems to be sort of sputtering as well. So at what point does the strategic composure break? I mean, this is in a way, follow on to my question earlier as to at what point are they forced to take tough decisions?
It's hard to say because you would have to understand the state of the debate. And it's always hard to understand the debate within a government, but of course, especially hard in China because, much of this debate occurs behind closed doors. And people are very reluctant to give information. I get information because I've been here for 21 years. I know people quite well, particularly my students, some of whom are very successful, and I get information from them. But I won't pretend I know the state of the debate at Zhongnan High, which is in the leadership compound. I do know that they seem to be very worried. They're behaving as if they are very worried about the slowdown in the economy. And there seems to be a consensus that this is a distribution problem, right? But my big problem, as I said at the beginning, is that a distribution problem means a transfer from A to B. We are talking about the transfer to B. We are still not talking about the transfer from A. And I would submit to you that that's the hard part, right? Until you resolve that, then nothing else is resolved. So I think that's where we are. We need to move in this direction where there's a clear understanding of who's going to pay for the transfers, who's going to pay for the debt, how are these costs going to be absorbed.
So, and one very obvious question, and there are longer term consequences of this. So we briefly discussed this. We didn't discuss in this call. Is this interest rate differential? The fact that now for many durations Chinese rates are now lower than US rates, and given the preference of the US for high fiscal or tight, loose fiscal, tight monetary policy, we could see sustained high US rates. So we have seen US yields, 10-year yields at 4.5%. So this is naturally very negative for the CNY, right? And we have seen the Chinese, the PBOC intervening heavily to sort of stem the losses there. So what do you think their currency policy is going to be?
They want stability. Remember that, a lot of people will tell you that if your economy is slowing, you should depreciate your currency because then growth will pick up. And that's not quite true. What happens when you depreciate your currency is that Obviously, you make imports more expensive and exports more profitable. So you transfer income from importers to exporters. And importers are basically the household sector, and exporters are basically manufacturing. So it's a transfer of income from households to the manufacturing sector. Is that a good thing or a bad thing? Well, if you're running a current account deficit, then by definition, your investment is being constrained by lower domestic savings and whatever savings you're importing from abroad. So if you depreciate your currency, you increase domestic savings, and presumably that goes into domestic investment, and that causes more growth. But remember, China is not the typical developing country with a current account deficit. It has the biggest surplus in history. It doesn't want to increase savings. It wants to increase consumption. So if you depreciate the currency, you are boosting domestic savings, which it doesn't need, and you're undermining domestic consumption, which it needs. And the PBOC has been very clear about that. They understand that. They don't want the currency to go down, and they don't want interest rates to go down, because interest rates do the same thing. They take money away from net lenders, who are household depositors, and deliver it to net borrowers, who are businesses, governments, etc. But at the end of the day, they can't control the process. If money is leaving China, that puts downward pressure on the currency. But the PBOC, you have this big conflict. Manufacturers say they want to see a weaker renminbi because exports are the one good thing. And the PBOC says we don't want to see a weaker renminbi because that undermines the rebalancing of the economy. So that's why there's been quite a bit of stability. Now, people may think it's strange when I say there's stability in the renminbi, but that's because most people look at renminbi dollar. The PBOC doesn't. It looks at renminbi CFETs, the basket, of which the dollar, I think, is 40% or something. And against the basket, the renminbi is about where it was, maybe 2 years ago or something like that. It hasn't moved that much. And I think that's what they're trying to do, is to maintain stability there.
Right, and that actually is one of the bigger points. In fact, and that's another question from Rasik Shah of RIL, that CNY as already to about 3% of the global share in terms of invoicing, and so as there is an attempt, like what we saw with China and Saudi Arabia, of course, clearly China and Russia, and there seems to be increasingly in West Asia, and what the US calls Middle East, but of course it's West Asia for us. There is a much stronger relationship with China now, and given how dominant China is in the Asian region in terms of its trade links, is there a possibility that China could trigger a policy of de-dollarization, and if at least from the invoicing perspective, and what are the chances? And there's a follow-on on that on India starting to sort of do more of this as well in terms of invoicing more and more in INR.
I'm very skeptical, and we could spend an hour talking about that. But the basic point that I would make is that when people talk about the dollar being the latest in a series of dominant reserve currencies, they're not reading their history correctly. There is only one dominant reserve currency in history, and that's been the dollar. Before that, there was gold and silver, and currencies mattered to the extent that their credibility the credibility of their exchange into gold and silver mattered. But this idea that the largest economy has a dominant currency is total nonsense. By the way, in the 19th century, the number one currency was not sterling. It was Mexican silver pesos. They were used in India, they were used in China, they were used in Latin America, they were used around the world. It was the credibility of its commitment to gold or silver that really mattered. The dollar is different because the dollar underpins global trade, not because we need a currency with which to trade. The dollar underpins global trade because the US has completely open capital markets and is willing to absorb almost unlimited amounts of foreign capital, which is another way of saying it's willing to run enormous trade deficits. Now, I think that's a big problem. I think the U.S. should stop that. I think the U.S. should remove the use of the dollar as the dominant currency. But the truth is, countries like China, Saudi Arabia, Brazil, Russia, all of which are surplus countries, they can complain all they want. But at the end of the day, the reason the dollar is the dominant currency is because they are so dependent on their surpluses. And those surpluses have to be invested somewhere. And they're all invested in the US. That's why the dollar is the dominant currency. I don't see that changing anytime soon. Neelkanth, I see a message here, which I want to address very, very briefly. Somebody asked, how does China maintain competitiveness with rising wages? And I think this is a very important point. Countries are not competitive because wages are low. Companies are competitive because wages are low relative to productivity. And the way to think about that is you look at the wage share or the household income share of GDP. You will notice that all the persistent surplus countries, Japan, Germany, South Korea, China, the Netherlands, Taiwan, in all of those countries, the household share of income is very low, which is a way of saying that even when they are high wage countries like Germany and Japan, their wages are low relative to their productivity. That's why they're competitive. And in China, they're lower than ever. So China is more competitive than ever.
Absolutely. And then it actually has to do with capital input. I think if you give people a lot of machinery by taking their savings and investing in robots, it tends to support that. Now, so the question also is that, multinationals are now starting to talk about a China plus one strategy, right? And you would recall that even today, out of $3.2 trillion of Chinese goods exports, more than $1 trillion or 31% is coming from multinationals exporting out of China. And so that percentage is lower than 58% in 2005. But what if that exodus, and what we hear anecdotally is that, like, just as AirPod manufacturing shifts to Bangalore or Vietnam, that the factories are shutting down in China and shedding workers and all of that. Now, how big is that as a trend? And a corollary to that, there is now a lot of research that is coming out, which is showing that, or let's say some research that is coming out, which is showing that the America's trade policy towards China is not really working, in the sense that at a headline level, the share of imports coming from China has dropped, but if you see the value add in those exports, you just cross 20 kilometers into the border into Vietnam and you start manufacturing there, and a lot of you're just sort of doing screwdriver stuff there. The value add is still happening in China, right? So two questions. One, how serious is this, and is this really a serious impediment to China? And the second, is this policy of trade control, and now Mr. Trump has said that he's going to put 10% against everyone. The point is, are these effective?
No, I don't think they will be. And Matt Klein and I published a book in 2020 in which we talked about the Trump tariffs, and we said the best the Trump tariffs can do is reduce the bilateral deficit the U.S. has with China, which will be matched by an increase in the U.S. deficit with the rest of the world, and an increase in the Chinese surplus with the rest of the world, which is exactly what happened. And the reason is because China's surplus has nothing to do with whether or not they import or export to the U.S. or anybody else. China's surplus is, by definition, the excess of savings over investment. And as long as Chinese savings are much higher than Chinese investment, it's going to run a surplus. If it can't run a surplus with the U.S., it'll run a surplus with someone else. Who's going to run the deficit? It depends where those savings go, and those savings mostly go into the so-called Anglophone economy. 70 to 80% of the excess savings in the world go into the US, the UK, Canada, and Australia. So those countries are going to run the deficits, maybe not bilateral, but they're going to run it anyway. Now, will that go on? I don't think so. I think a lot of countries, including India, are less and less comfortable with running these permanent deficits. And I think we're going to see a shift in the organization of trade. But until then, the idea of the deindustrialization of China or the offshoring, I think you have to be very skeptical. Manufacturers are not in China to be nice or because they like the food. They're in China because the subsidies to the manufacturing sector in China are enormous, direct and indirect subsidies. You can borrow at negative real rates. You have an undervalued currency. You have the best transportation infrastructure in the world. The transportation infrastructure is way too expensive. It's bad for the overall economy. But if you own a factory, the fact that they've overspent on roads and bridges, that's great for you. It's another subsidy. So the reason you're in China is because the direct and indirect subsidies are so high, they exceed that of any other country in the world, that by definition, your manufacturing capacity, your manufacturing is extremely competitive. You don't even have to be particularly good at manufacturing. It's the subsidies that make you competitive. And from what it looks like, as you and I have discussed, China's response to the slowdown so far has been to increase manufacturing subsidies, which is why their share of global exports and global surpluses is going up, even as the world contracts. I don't see that changing anytime soon. What it'll take to change it, in my opinion, is a change in the way countries, particularly deficit countries, perceive their relationship with global trade, as they become increasingly impatient with what are effectively mercantilist policies. I think they're going to force changes on the global trading environment.
So from a competitive perspective, so what we are seeing is that that there is a response to that, right? So I think the Americans started off this process with the Inflation Reduction Act, massive subsidies on batteries and solar cells to the extent possible. And India does not have the same level of resources, the government, but we are seeing, schemes which are subsidizing batteries, schemes which are subsidizing the manufacture of solar PV cells. If you see the size of those schemes, so for example, the capacity that is targeted is about 50 gigawatts a year, which is broadly what India intends to add over on an annual basis. So at least for what they need, they are trying to subsidize. And if the Chinese subsidies are going up, then I think that these will be ramped up further. On semiconductors and hardware, everyone from Thailand to Vietnam to India, and we've seen VinFast, the Chinese, the Vietnamese, EV company. So do you see a competition? So there is one which is the competition on the subsidies themselves, and the second is just the fear that if there is a disruption like what we saw for a few months during COVID, we should have an alternative, right? And we are hearing from companies in India, like foreign companies coming to India, that we just want an alternative. I mean, we don't want to have 90% of our manufacturing coming from China. So both of those, I think, are serious factors, at least that some part of the manufacturing will shift away from China.
Eventually, yes, but it's going to be for political reasons. It's not going to be for economic reasons. That's why I say what really matters is how countries like the US, Europe, and India respond. If we do nothing, I don't think there's going to be any shift of manufacturing out of China. In fact, I think the Chinese share of global manufacturing will continue to rise. But I think there is a perception that we live in a very mercantilist world. We live in a very beggar thy neighbor world. And unfortunately, in a beggar thy neighbor world, if you don't do it, you lose, right? So everyone's going to take steps to protect domestic manufacturing. And that's what I think disrupts this whole process. But to me, that's a political thing. When we make the political decision to do that, it will happen. Until then, I don't think there's any reason to expect a shifting of manufacturing out of China.
Understood. So I would like to remind the audience that they can ask a question. I think we can take some of the last few questions. We are already over time. So I'll ask a final one that there is so you talked about regional imbalances, right? So again, the mistake a lot of people make when looking at China, I mean, as I think they do when looking at India, is that it's not very uniform, right? And so at a national level, it doesn't look like there are problems, but are there regional level problems which can catalyze the government or can catalyze action by the government? Like, as you said, some of the southeastern states, I mean, there are regions, provinces are really at, US levels in terms of per capita income. But when do the fault lines start becoming unbearable in some of the regions, and which then forces the government to act more forcefully, or instability starts to come up? Because clearly it's a very large country, and most people in India would recognize that if say a big problem start emerging even in a small state like Manipur, I mean, it becomes national news. So when do those kind of stresses start emerging, and are there any indicators that those of us sitting outside China can track about these regional issues?
That's something that I don't want to claim any special expertise on issues of domestic instability, political issues. I read the newspapers like everyone else. What I would say, before I moved to China, I ran fixed income trading desks on various Wall Street firms, and putting on my trading hat, one of the things that worries me is that when there's a problem in China, the first reaction is to prevent any information from going out and to suppress the problem. So a major money manager went bankrupt. There was rumors that people were going to show up at the headquarters and demand their money back. And apparently they were all visited by the police, and they were told it's not a good idea for you to go and protest. Now, again, from my trader's point of view, this to me is a volatility enhancer. If the problem is small, you can cover it up and no harm done. Nobody will know. But we saw that, for example, my first year in China was when we went through the SARS process. And remember, when SARS came out, they immediately covered it up. As they had many times before, other diseases had been covered up. They turned out to be no big deals. Nobody found out. Nobody was the wiser. But when it's big enough, then the very act of trying to cover it up makes it much worse. Because if it breaks through, and I remember in Beijing, it really struck me, there was like a 3-day period in which we went, SARS is not a problem, ignore it, to, oh my God, SARS is going to kill us all. And I remember when they announced that there were no dead people in Beijing hospitals, and then we found out, because army hospitals are not defined as Beijing hospitals, and the moment you were sick, they moved you to the army hospital. So you died there, but technically you didn't die in a Beijing hospital. When that news came out, there was complete panic within the city. And that's what worries me, because usually when you repress bad news, you can get away with it. Every once in a while, you can't get away with it because it's bigger than your ability to suppress it. And the very fact that you try to suppress it seems to make the reaction much worse. So that's a long way of saying that probably we are not going to see significant disturbances because they will be suppressed effectively quite quickly. But the problem is that every once in a while you're wrong, and then it's very unpredictable what the reaction is going to be. So that's just my very 30,000 foot in the air view. I worry about the tendency to suppress bad news, but it usually works.
Right. And so one quick follow-up from me on the external account. So we've discussed a lot about the goods surplus, but we also know that China runs a services deficit, and that's very important when it comes to providers of these services, like the other Asian economies. So when we think about, so at a macro level, I have complete agreement with what you said, that look, the rebalancing will matter more to China than the rest of the world, except if you're a iron ore supplier or a bauxite supplier or something. But if you're sitting in Thailand and 50% of your tourists come from China, or you're a Korean beauty products company, or a Japanese beauty products company, or a European capital goods supplier, isn't that enough of a contagion effect in terms of a potential slowdown, which then sort of cascades through the world?
That's why I say it's really important to understand not just what happens on average to the economy, but to understand the rebalancing process. Because if growth rates slow significantly, but China is able to rebalance, which Japan did in the 1990s, GDP growth collapsed, household income growth didn't collapse, then you're going to continue to see consumption of goods and services rise. People will continue to buy, Korean beauty products and Japanese movies and things like that. The key is what happens to the household share of GDP. If China adjusts the way the US did in the form of a crisis, the way the US did in the 1930s, then I think that's going to be really painful for everybody, because Chinese exports will drop, Chinese imports will drop by a lot more, and the world will have to absorb even more deficient Chinese demand. So the key is the way in which China adjusts. If I have to bet, I'll bet that it'll be a Japanese-style adjustment. It will not be disruptive for the rest of the world. But I do want to say, the longer we go on, the more uncertain I am about the stability of the adjustment.
So thank you. So I'll now move to the last question. We've already stretched quite a bit, but I see there's still quite a bit of interest. But China clearly, from a geopolitical perspective, given that they have strong trade links on the goods side, the services side, and a lot of the technology they've developed, for example, massive investments in batteries. They're already 60% of global electric vehicle production. They're now a bigger auto exporter than Japan. So it's also an exporter of technology. It is also, I think, likely to, and while One Belt, One Road may not have worked as well as they thought over a longer period, but how does the rest of the world kind of benefit as they try to use their dominance in some of these sectors, whether it is digital payments or export of technology, or like the battery ecosystem, and try to use that to build friends? And how does that affect the rest of the world?
I would change the question a little bit, and ask it in a different way. How sustainable is their success in technology?
Yes.
Because they're very successful, and I think China will continue to be an important source of new technology. I think they're quite good at it. But the question is, are they successful in technology because they are especially efficient at technology, or are they successful in technology because of the enormous direct and indirect subsidies that flow into the tech sector? If it's the latter, then ironically, their success in technology doesn't equate to economic success. It's not sustainable. It may actually impoverish the country. And I'll give you an extreme example, and that is facial technology. China is by far the world's leader in facial technology. Caixin, which is my favorite Chinese magazine, did an article about a year ago in which they looked at the top 4 facial technology companies that dominate, they're 90% of the market. And what they found was quite interesting. I'm surprised they were allowed to say this, but Caixin is allowed to say things that lots of other Chinese newspapers are not really allowed to say. But what they said is that one of the four companies, 90% of their business was with the government. Two of the companies, 60 to 70% of their business was with the government, and they didn't have data for the fourth, but probably in that region. And to me, that's very interesting because the government buys facial technology for security reasons, right? Now, you may have very good reasons to want to beef up your security, but it's not productive for the economy. So that's a classic case in which China is the world leader in facial technology, but they're not getting richer from their leadership in facial technology. They're getting poorer. Again, you can argue that it's justified. Maybe the security needs are important. As an American, I'm very skeptical, but anyway, that's a political argument. But the point is that they're not justified. And I think that's something that's very hard to understand. You know, if you, I always tell people that one of the most interesting things for me on YouTube is the famous kitchen debate between Vice President Nixon and Khrushchev. In which this was in the early 60s, late 50s, and it seemed like Soviet technology had way surpassed the US, particularly in the space side. And you see this discussion, and it's very clear that Nixon is embarrassed about American technology, and Khrushchev is incredibly confident about the quality of Soviet technology. We look back on that today and think that's ridiculous. US technology was so far ahead of Soviet technology. But in certain areas, Soviet technology was in advance of the US. And yet they were never able to convert that into anything sustainable. You know, I would argue that that might be a problem. Heavily subsidized technology can produce spectacular results, but it's not sustainable.
Exactly, and when your faith in the markets is shaken, right, and if you're feeling discomforted by growth of the private sector, then the private sector, their ability to commercialize, take long-term bets, which is very important for the technology to have economic impact. I think that's something that we are challenged. So I can keep going on and on. This is a fascinating topic. I think it's very, very important for all of us. And of all of our clients. But let me thank you and on behalf of Axis Bank, this concludes the discussion. I would like to convey our gratitude to Professor Pettis for his time and sharing very frankly all his perspectives, very deep perspectives on all the questions we had. For the audience as well, we look forward to for you to join us in future editions of the Treasury Market Talks. The recordings of this discussion will be available in case you wish to have this passed on to your colleagues. If you find this useful, you can connect with your relationship managers for help. Once again, thank you for joining us, and now you can.
Thank you very much.
Thank you. Thank you, Mike.